How does interest accrue on a reverse mortgage loan? Imagine having a home that helps fund your retirement, but as time goes on, the amount you owe on that home can grow without you even realizing it. That's because of how interest works on reverse mortgages. When you get a reverse mortgage, you're borrowing against your home's equity, but unlike a regular mortgage, you don't make monthly payments to reduce the loan. Instead, the interest is added to the loan balance itself. This means that each month, interest is calculated on the current amount owed, which includes any interest that was added previously. It's like a snowball effect where the loan grows bigger over time. When you take out a reverse mortgage, the amount you borrow can be paid to you in different ways. You might get a lump sum, monthly payments, or a line of credit. As you receive these funds, the loan balance increases by the amount you take out. The interest then starts to accrue on this new, higher balance. The more you draw, the more interest will accumulate. The interest is usually calculated daily or monthly, depending on the lender's rules. The interest itself is of two main types: fixed or adjustable. Fixed interest rates stay the same throughout the life of the loan, making it easier to predict how much interest will accrue. Adjustable rates can change over time, which might cause the interest to grow faster if rates increase. Since interest is added to the loan balance regularly, the total amount you owe can grow quite a bit if you don't make payments. For retirees, understanding this process is important because it affects how much equity remains in your home. Over many years, the loan balance can grow to be a significant portion of your home's value. But remember, you are not required to make monthly payments on the interest or principal while living in the home. The loan becomes due only when you sell the home, move out permanently, or pass away. At that point, the total owed, including the original amount borrowed plus all accrued interest and fees, must be repaid. Most reverse mortgages are non-recourse loans, which means if the loan balance exceeds the home's value at the time of repayment, you or your heirs are only responsible for the home's worth. The extra amount is covered by mortgage insurance. To keep track of how your loan is growing, it's a good idea to review your statements regularly. If possible, making payments toward the interest can help slow the growth of the loan balance. In the end, interest on a reverse mortgage adds up over time by being added to the loan itself. It compounds, meaning each period's interest is calculated on the new, larger balance. This process allows retirees to access their home's equity without monthly payments, but it's important to understand how it can affect your home's value and what you'll owe when the loan becomes due. Being aware of this helps you plan better for your retirement lifestyle and housing choices.